Hi everyone, and in today's video I'm going to be revealing what legendary investor, this guy's track record is incredible. Legendary investor Peter Lynch's most famous phrase is, and why it is so important for you and your finances and that of your family. It really is. So make sure you do hit the subscribe button though, because I want to make sure that you don't miss out on all the information that we're going to be sending you over the next few weeks. I've got some absolutely cracking information which is going to help you and your family, especially at this time. So please go ahead and subscribe now. Okay, so coming back to Peter Lynch. Before I tell you what the phrase is, who is Peter Lynch? Now you might know this or not, but between 1977 and 1990, he was the head of one of the most famous funds of Fidelity. Fidelity is a huge fund management company called the Magellan Fund. And between that time, so 13 years, he averaged, this is pretty mind-boggling, 29.2% a year. Sometimes more, sometimes less. Now some of you might say, yeah, that's pretty good. I'm getting, let's say, 1% of the bank, so that's 29 times more. That's pretty good. And some of you might be kind of more short-term traders or medium-term investors and would agree that maybe that's not so good, 29%. But let me tell you the differentiation. I don't know how much money you have to invest. Let's say it's 10,000, 100,000, a couple of million. To do 29% on that kind of money is good, but it's not extraordinary. But he started with 14 million, and then obviously as his track record and his reputation started spreading, he attracted more money, and it ended up with 18 billion. Okay, now when you think about that, or between 40, I think it was about 14 billion actually, but still 14 billion to manage to attain 29.2% on average with anywhere between 18 million and 14 billion. That is really some feat, I can tell you, because his main challenge and Warren Buffett's main challenge is what? It's where to put the money. Because let's say you find a company that's really good and you want to invest. Well, with that much money, you might have to buy the whole company. So it really is a challenge. Their biggest challenge is, they've got too much money. Anyway, so let me tell you, and then I've got a really interesting fact for you as well, which I'll reveal in a moment. I'll reveal it to you now, but I'll tell you why that is in a moment, okay? Hopefully I'll remember. Which is that most people, even though for 13 years, by the way, Warren Buffett's track record is longer, okay, but he only manages about 21, 22% a year, but it's much, much longer than 13 years. So you can argue who is the best investor. But most people that invested in that fund actually lost money. How is that possible? How did most people, and I'm going to tell you why in just a moment. I've got to remember to do that. But I want to go into this. He said, this is one of his most famous phrases, know what you own and know why you own it. Now, as a trader, you don't need to do that because you could just buy and sell anything. It doesn't matter because you've got a stop loss which takes you out automatically. Right? You can do anything. The worst companies you can buy because it doesn't matter. In the short term, it might still go up, right? Because that's trading, short-term volatility. But as an investor, which he clearly is, Peter Lynch, you have got to really look at the fundamentals of what's happening in the market, in the sector, in the industry, and in the company itself. And he's published several books about this as well that you might be interested in if you really want to get into the fundamentals of things. So look up Peter Lynch, like Beating Wall Street or One Up on Wall Street. I think one is Beating the Market and the other one was One Up on Wall Street. So that might be worth checking out if you want to get into fundamentals. So his thing is all about fundamental investing. Now, obviously, we at Investment Mastery do a little bit of fundamental, but it's a lot of technical as well, and we try and combine the two together. Plus, we have, we're looking for a little bit more than 29%. That's what we're looking for, and therefore we like that volatility. For example, in Bitcoin. Now, here's what's so interesting. When he says know what you own and know why you own it, I think a lot of people get into something. But do they really, really understand what they're getting into? Like you, for example, the last 5 times you invested in something, did you really know what you were getting into? Have you bought any Bitcoin, for example, but do you really understand it? Have you done a deep dive? So in 2016, when I first, not heard about it, but first got serious about it, so late, why did I do that? I went deep down, did a real deep dive research, and then wrote a book about it. So that was my way of researching it, was to write it all down into different chapters: why, when, how, who, etc., and so forth. So I'm not saying you have to write a book about it. What I'm saying is, have you really done your research? Like, you own some Bitcoin or Ethereum or some of the other coins. Do you really know what they really are? And let me tell you why that's so important. Right? Because you might say, well, is that important? Well, if you have a strategy like our VCA, for example, and our strategy is, as soon as it falls a certain percentage, we get in the first time, hoping not that it will go up, but that it will carry on going down. So we start feathering in at certain points, which are set in advance. Okay, so it's not just a knee-jerk reaction, it's set in advance with certain amounts of money. In fact, we increase the amount of money. Now imagine you went into something and you didn't really do your research and it started going down and you wanted to buy some more and some more and some more. At some stage you would go, oh, do I really want to keep buying because this keeps going down? Whereas if you think about it, if you really bought a really good company and the stock price goes down, and it does, by the way, people say, well, why would a good stock go down? Because that's the short-term perception of the market. Stocks can go down in the short term, even in the best company in the world. That's our opportunity to get in, right? That's why the stock market is so great, because it does fluctuate. And then you would kind of go, if you didn't do your research, you would go, oh, I'm going to stop doing this. But that last time that you enter, which brings the average price down, was so important. Okay, so that's called feathering in. And we do that with our VCA strategy. Warren Buffett, he would do that as well, right? If he has, because he believes in investing in businesses and people. So therefore, when he invests in something, when it goes down, he will buy some more. But, and this is important, know what you own and know why you own it. So when things change, when the fundamentals change. So I remember a few years ago, he bought Tesco, but then it went down and he got out. So he actually nurtured millions of losses because the fundamentals had changed, because the why he owned it had changed. Does that make sense? The same with the airlines just recently. He got out of Delta, right? Because the fundamentals due to the coronavirus meant that the fundamentals have changed. Now, so he got out and he made losses, but that's fine because it carried on going down. Now, he might get in at the bottom if he thought the fundamentals had changed. Again, the why had changed. So I'm going to repeat it again. Know what you own and know why you own it. And when you do that, then all of this is just noise. Oh, it's gone up. Well, okay, well, let's see how much more it goes up. It goes down. Doesn't matter. I own a good company. Does that make sense? So that's why these people have a kind of a medium to long-term horizon, which allows them to sleep at night, which is good. Okay. Now, I remembered. Okay. So Peter Lynch, one of the greats in investing, 29.2% on average per year for 13 years. Would you like to have had that in your portfolio? But most people lost money when they invested in the fund. Now, I'm going to tell you why, but what I want you to do is I want you to comment below. Just see whether you can work it out. Don't be shy about this. We're not here to look cool. We're here to learn, yes? So just see whether you can write down below, comment below, why you think. Go on, just go ahead and do that now, just quickly while I'm explaining it. Why do you think that most people who invested lost money, even though it averaged 29.2% a year? How is that possible? Go and comment below, and I'm going to tell you in 5 seconds. 5, go on, 4, 3, 2, 1. Have you finished? Okay. Because he's an investor and doesn't just buy when things go up or sell short when things go down or sell options in order to get revenue or any of the other techniques that you might use, he is going to be open to the fluctuations in the market, which is just noise, right? If you believe in something, then over the long term, it should go up. What do most people do though? Even when they're investing with somebody like Peter Lynch. In the year that it goes down, because this is an average, the 29.2 is an average, so sometimes it's more, sometimes it's less. So in the years where he wasn't doing so well, when the markets crashed, for example, and he's invested, and they saw their portfolio go down, what do you think most people do as a knee-jerk reaction? They sell with a loss as a knee-jerk reaction. Not because the fundamentals have changed, because they just think, oh, he's not doing very well, and they get out. And of course, when it's down, that's the worst time to be selling, isn't it? That's the time you should be buying if you believe in the stocks that Peter Lynch, and he obviously did, invested in. So what people would do is they would get out, okay, and then wait for it to go back up again, look at the track record again, and then get in again. So they're doing the opposite of what you're actually supposed to be doing. They're getting out at the worst time. That's the time to be probably getting in, right? And as things go up, instead of selling a little bit, no, that's when they would kind of go, oh, it's time to get back in again. So they do the exact opposite of what we teach. Okay, and that's why most people, they should have just left it in there. You know, they would have done better. Or what I would have done probably is I would have just added to the position when it went down, not sold. What Dennis, my head trader, would do is he would start feathering out going up, okay? And then as it goes down, start feathering back in. So start buying, and as it goes up, selling, which of course is what we teach at Investment Mastery. So I hope you enjoyed that video. I hope you got something out of it. Please do make sure though that you do hit that subscribe button right now, because I'm going to be sending some really great information your way over the next few weeks and also months to help you and your family and your finances. So go ahead and do that. And if you did like the video, then please do hit the subscribe button as well. I'd be most grateful. So I hope your comments were on there. Did you get it right? Did you not? What do you think about what I just said? Do you think it's right about, you know, when markets are falling, getting in? I mean, obviously you'd have to do your research. You don't just get into anything, obviously. And that is why know what you own and know why you own it still holds true today when you're investing, okay? So go ahead and comment below. Let me know what you thought about the video. Let me know what you think about Peter Lynch. Maybe look him up and then just leave a little comment there as well and what you learnt today. And remember, always invest with passion and profit.